Hello everyone, welcome to your retirement newsletter for Friday. Today's July 15th. We had a really hectic, crazy week. Try to stay with me. I'm going to kind of just go over what happened economically. The market is up today, which is kind of what I thought would happen. But anyway, I'll talk about those CPI numbers, PPI numbers, the 2 and the 10 inversion. Also, we'll talk kind of a little bit about how healthcare has the inflationary kind of issues when it comes to healthcare. Let me just shut off my volume here so you guys don't hear any of the alerts I have going off. And how high deductible plan G kind of is a really mispriced product. I feel like it doesn't really match true healthcare costs. Kind of talk a little bit about supply chain, and we'll kind of talk about a really good product I think that everyone should have if they already don't have. It's just super safe, and I think especially for people who are on Medicare, definitely pick it up. But we'll go into all that. Hopefully I can wrap all this up in under 25 minutes. That's going to be my hope here. I did this before and it came out to about 45 minutes, so I need to condense it, and here's my attempt at that. Okay, so first off, the CPI came in at 9.1%, which is really high. It's higher than before. Importantly, it's higher than estimated. That's kind of why we had a really crazy sell-off when the number came out on the 13th. And we also had higher than expected jobless claims, unemployment. The amount of unemployment claims has gone up and is over expectations. And also the PPI index, which is the producer price index, that's kind of like the raw material cost, is also up 11.3%, which is much higher than even the revised PPI assumption, which was somewhere around 8.9. So it's very, very bad when it comes to the economic kind of assumptions. And what this tells us is that the Fed and all the economists working and looking at the US economy really are, even though I thought anyway that they were going to be a little bit more hawkish and a little bit more aggressive and a little bit more kind of hit them harder, and then when the real numbers come out, it'll be a relief, has been the complete opposite. We've been predicting inflation to be higher, and it has been higher, but now it's higher than even what people are, or what the government is telling us, or what the government is assuming, what the economists who work in the government to do this assume. So what is actually higher? So I have this really nice infographic here. Hang on. Here we go. So this is from Statista.com. They're kind of put infographics to a lot of things that come out. And this shows us the June 21 to June 22. That's the years, right? 2021 to 2022. Highest kind of items, especially items that we consider staples in America, which is eggs, butter, flour, chicken, milk, baby food, used cars, and fresh vegetables. Used cars kind of just snuck its way in there, but used cars has been a point of kind of reference because when the pandemic first started, used cars were like going through the roof as far as their price increase. So it has gone down, or it's not accelerating that quickly. But what are things like eggs, butter, flour, chicken. So, if you make chicken and dumplings, maybe not. Maybe don't do that. Maybe make something else, right? Milk, baby food, and fresh vegetables, which really shows us that people are diverting a lot of their, or at least I would like to think that people are diverting a lot of their discretionary income to buy things like this, because the only way we could have price increases, inflation, like this is if they were priced to a point where people were now spending more money to buy the same thing, right? The same amount, they're paying more, and they are paying more and voting that it should be worth more by paying with their money. And the companies at which you buy them from, the grocery stores like Walmart, Kroger, H-E-B, your local grocery store, Foodland, Long's, all those places are purchasing these items at a higher cost, right? And they're passing down those costs to the consumer, that's us. And we've seen from the PPI, which is pretty much like how we can kind of figure out how much the price of the raw good costs, that has gone up even higher than inflation. So what we can kind of assume now is that we have this huge funnel of inflationary pressures. Costs more to have chickens, to feed them, to process them, to ship them, to deliver them. All that is increased. Therefore, the cost of eggs skyrockets. What this can tell us, though, about the PPI and how that 11.3 almost 2% over expected, what that means is that there's more of this coming. That funnel of inflation, we are here. We are like the end user, the end point of this funnel of inflation. And we have the PPI, which is the very top. The very top is still higher than the very bottom, which means that there is a point at which we are gaining value that we shouldn't, right? If it costs 11% more to get me my eggs, and I'm only paying 9% more, then there's a 2% problem, 2% gap. Now this PPI and the CPI index are a collaborative, so I singled out eggs here, but the PPI for eggs is probably even higher, like 40%, right? So just think about that. So costs are going up and they're going higher. And if you want the full report, it is here. I'll link it in the description in the video, and I'll probably link it in the email as well. So, inflation and the stock market. What will the Fed do? So a lot of people, Invesco is a huge investment company. They actually sponsor the QQQ, which is that huge ETF that tracks the NASDAQ, something that's heavily traded. Because it came up so high, what is the Fed actually going to do? Well, we think, at least I think, that the 50 basis point hike in September won't happen. I think it'll be higher to 75 or even at 1%, 100 basis point increase. Now this would be insane, but the Bank of Canada has issued a 100 basis point increase on their, what they consider their federal funds rate or the overnight rate. So it's getting kind of scary. Additionally, another pressure, right? So we have inflation up by means of the PPI, CPI up, unemployment up, right? So these are all the metrics that can signal us to have a poor economy. I'm not going to use the term recession because we are already, in my eyes, in a recession since the Fed, I forget what word they used, but they changed their outlook on GDP to be negative already 2 times. So we're already there. It doesn't matter. It's just a term we use to quantify something. It's not indicative of what's actually going on. It's just indicative of GDP going down. So what's actually going on is we have raw cost of goods going up. Therefore, our costs are going up. And we have people who are unemployed, which is making it harder for the economy to get more items. So if people remain unemployed, the people who are employed perhaps will want more money to do those things that are in relation to getting items to market and then selling them to consumers. Additionally, the 2 and 10 year bond have inverted. This is a tail kind of case of a recession, which we're already in my opinion. But the 2 and the 10 year, that means that it's cheaper, or more expensive, depends on how you look at it. But a 10-year bond is paying less interest than a 2-year bond, which means that to get money quicker, it costs more, which doesn't make sense, right? If I loan you out money for 2 years and I tell you that your interest rate is 5% per year, or I loan you out money for 10 years and I tell you the interest rate is 4%. It wouldn't make sense to you, right? Like, why is it now that the 2-year is paying so much more than the 10-year? Why? Because we have a mispricing in bond rates. That means that risk is priced higher in the short term than it is in the long term, which is a very interesting dynamic when it comes to the markets. It can happen. It's happening. But you can kind of think of it as, imagine if you were to take out a 15-year mortgage. Usually 15-year mortgages have a much lower interest rate than a 30-year. Imagine this. Do you go to the to the bank, and the bank tells you, you know what, a 30-year mortgage is actually cheaper than a 15-year mortgage. You would think something is askew, something's wrong, or I'm getting the best deal of my life, right? That is what's happening now with the 2 and the 10. Okay, so that's kind of to give you guys something you can kind of chew on. Inflationary hedges. So a lot of people flock to gold. Gold is supposed to be the inflationary hedge. Unfortunately, gold is performing really poorly. And our inflationary hedges now are falling short too. We have corn, wheat, soy, all falling off a cliff. Natural gas fell off a cliff. Oil back under $100. But yet, inflation is still ravaging its way through. Now this could signal one of two things. Either a complete forego of old kind of economic levers or old economic correlations where we have commodities going up, inflation going up, and commodities going down, inflation going down. That's whole tandem being shifted out. Or it's a signal that inflation has peaked. Remember, all the economic reports that come from the Fed are old, right? This number that we got in the middle of July is for the June to June numbers. So potentially, because the market prices things in the future, we could be looking at a peak, or at least a turnaround of the acceleration of inflation. So let's say this next Fed meeting in August, or the end of this month, and then they release new numbers in, let's say, August or September. Those numbers might be 8%, which means that inflation has peaked and now is going back down, kind of going back down to that target 2%. That happens, great, right? Market might have already priced it in, market might not have. We don't know yet. But there are still a lot of pressures. So, pressures. What are the pressures that we have? Well, we still have the war in Ukraine, right? That has still, for those of you who don't know, that's still happening. There is no resolution yet, right? That is still happening. Okay, we have unemployment, we have cost of items being so highly inflated. We have people who are, unfortunately, now less than before able to purchase enough food, enough medications for themselves. So I don't think we are headed in the right direction just yet. And I feel like because the government has so much debt, remember, if the bonds are more expensive, this means the federal government has to pay a higher interest rate on the $30 trillion of debt that they have. This could make our debt grow. It could also put constraints on certain programs, government programs that are supposed to come out. Right? I don't see it being a very good situation just yet. And how would we know if we're out of it? Well, we wouldn't really, until we are indeed out of it, until we feel like we have enough money to purchase things. And this is going to sound strange, but there's this thing called the men's underwear index. Pretty much if men stop buying underwear, the market usually is crashing. And when they start buying underwear again, the market kind of starts recovering. It's kind of like a thing where, men don't really want to buy more underwear until they feel like the market is doing well, or at least the economy is doing well, because it's something that you don't need. Because you typically have, and you can wear it till it dissolves pretty much, right? I think many people have heard that. Fortunately, it's not me. I just make sure I have good quality stuff. But anyway, we are going to go further and talk a little bit about that product I said. So this is something I bought a little while ago. It's called the GE 4-in-1 Power Fairly LED Nightlight. So I have this in my bathroom, and what it does is it's a nightlight, but if the power goes off, it still works. You can unplug it from the wall and it will work. I'll do a review video pretty soon, probably on my personal Matthew Bargudo channel. But I really like this because if the power goes out at night, it'll be pitch black. And my wife's grandmother had mentioned that during the Great Freeze, or the Big Freeze in Texas in 2000, gosh, was it 2021, 2020, whenever it was, all the lights went out, and it was so dark that you cannot see anything. You have to rely on your memory on where things are in the house, and that's really scary. She had to go on her hands and knees and crawl around and navigate to, where she puts her flashlights and her matches and things to light candles. What this will do is it'll prevent that from happening. You have one of these it's in my master bathroom, but you can have one of these, in the hallway, and that way when the power goes out, this thing will keep itself lit up. It has batteries in it. This is the one that I have. It's relatively inexpensive right now on Amazon. It's $15. You can get it. You get 2 of them for yourself, and it's really cool because you can use it as a tabletop light, a flashlight, and of course, what I use it for is an emergency light. All right, that's your sponsorship kind of thing. Please use the link in the description below if you want to purchase it. Helps out the channel so I can make these videos and keep them coming to you for every week. So the SPY. This is the 2-day chart of the S&P 500, or the SPY ETF. The hourly looks kind of crazy, but we did have a really good last 2 days. We're kind of selling off right now. It's only 11:30, so it's the lunchtime lull, probably, or it's 11:15 Central, so in New York it's 12 o'clock. But we are pretty much in a healthy bounce. Now, I am one who believes that because we're still in a bear market, this will probably fizzle out. If we pull ourselves further, we look at the weekly, we are still in a pretty strong downtrend here. And a lot of these are just kind of oversold bounces, we call them, where like it's so oversold that it has to go back up. Shorts have to cover, and institutions are usually buying every week or every month or so, based on like people who have automatic contributions to their retirement account and such. So that's kind of why it has to have that kind of uplift. But again, the downward trajectory still there. I don't like to call bottoms or tops or anything like that. So I feel like for the most part, the market will still be kind of risky, as a lot of investors are on a risk-off mentality, and also a lot of companies which are doing earnings. Earnings season started yesterday. JP Morgan Bank, they announced their earnings, and they had to navigate downwards for their projections, and they also missed on both their top line and bottom line earnings, which is significant because JP Morgan is a huge bank, and they also have they kind of are guiding lower, which really sucks. Yeah, their weekly is going to be down. Just check their daily. Today they're up. Yesterday they closed just on the so they had a huge gap down yesterday, but today we had a nice opening back to where we were kind of yesterday. That's kind of been what I was talking about earlier, about how we get severely oversold and then we kind of bounce back. But theoretically, what happens next is another leg down, kind of just hitting that last level of what used to be the kind of accepted bottom, and if we reject it, we go down from there. We are now losing this as a key level of support, and we kind of falter downwards. That's the theory anyway. I'm not going to bore you folks with more technical analysis. If you want, you can take my course. All right, so inflation and income. All right, so The COLA increase for next year has been projected at 10.5% for Social Security, which would be great, right? If only, eggs weren't 33% more expensive, it might be something good. What that would mean is, actually they estimate the COLA to be 8.6% next year, which is definitely not enough. Neither is 10.5, but I don't think the U.S. government could afford a 10.5% increase. Anyway, what we are now kind of thinking about, or at least people who are on Social Security, is how do you generate more income if the stock market doesn't provide it to you, or your Social Security pension doesn't provide it to you? Well, you have to cut back. And that will force a lot of people, unfortunately, to look at either cheaper Medicare Advantage plans or cheaper Medicare Supplement plans. Now, the most efficient Medicare Supplement plan, in my opinion, is Plan N. Plan G or high deductible Plan G is the next kind of step down from there. But here's something that I just found out about high deductible Plan G when I was doing a thorough kind of deep dive. I don't normally talk about high deductible Plan G because, number one, it has such a high deductible that most people don't use it. And if you are to break even from a Plan G and a Plan N, it's really only 1 year. So if, let's say, for example, through the life expectancy of a 65-year-old to 24 years till 89, they have 6 catastrophic events, right? 6 years that, 1 out every 4 years, 5 years, they go to the hospital or they have surgery, right? 6 times throughout their 24 years of life. If they go to the hospital or have one of those events 6 times during those 24 years, then the high deductible Plan G is the better plan, right? Other than that, if you go any time less, then the Plan N is better. And this is simply because the premium difference between Plan N and high deductible Plan G is so that 6 years of this high deductible payment will be will be spent on care. Whereas in the Plan N scenario, you won't have this high cost because Plan N negates high costs from diagnostic tests like MRIs, outpatient surgeries, hospital visits, hospital stays, ER visits. All of those things could tap out or max out your high deductible on a high deductible Plan G, which means you're paying $2,490 in 2022. Now, the part I was kind of getting to, I'm watching my time here, is that the high deductible Plan G's deductible is not based on medical inflation or utilization of Medicare. It's based on the CPI. So, this wonderful calculator here. Okay, I kind of jumped the gun. But, so, in 1998, this is when high deductible Plan G came out to the market. High deductible Plan F, that is. The high deductible was pegged at $1,500, and it tracks U.S. inflation. With U.S. inflation, it is now $2,490, right? They round down to nearest 10. All right, so let's look at what is estimated to be for next year. 2720 or 2730, depending if they round up or round down. This is really high, and it's getting higher, and it's going to, I feel, in the next couple years, especially if inflation normalizes, where me and a lot of other financial people are kind of talking about, economists, is that inflation will normalize not at 1 or 2%. It'll probably normalize closer to 3 to 5, because right now, the only thing that can push inflation down is having a much more efficient market. So we would have to bring really efficient technology to the marketplace that will drive down a lot of labor costs or production costs. And we don't have any of that right now. None of it. So for it to meet the market and be dispersed to scale, it's not happening in the next 2, 3, 4 years. So we can expect inflation to remain elevated, at least over the 2% that we've kind of had hit as a target, unless, of course, the government decides to kind of pull the wool over us and say that it's at 2% even though it's not. It's kind of what I'm thinking. So this is not a good alternative. Plan N, even though Plan N has a rate increases, you will never have to pay more out-of-pocket costs per service like you would on a high deductible Plan G. Okay, so that's kind of my spiel on why looking for savings, don't look here. Okay. This is kind of unfortunate and I'm over my time, but I'm going to talk about it anyway. So for those of people who are healthy, you actually will spend more in retirement on healthcare than people who are unhealthy. And the reason why is because of life expectancy. Someone who has type 2 diabetes, their life expectancy, if they're 55 years old and they're female, their life expectancy is up to 80, which means that their lifetime retirement health cost is $266,000. They spend more per year, but they have less years to spend it in. For a healthy 55-year-old going into retirement, life expectancy is 89. They are spending $13,000 per year less. So almost $3,500 less per year. But throughout their entire retirement, they are spending $424,000, which is $158,000 more than the type 2 diabetic who lives only till 80. So the unfortunate thing is the longer you live, the more expensive it is. So if you're healthy, you still will have higher healthcare costs than someone who is unhealthy. You just spend it more stretched out than all at once. And that also, again, compounds on my high deductible Plan G kind of problems. High deductible Plan G, if you spend all your money or all of your income when you're unhealthy, a lot of times those years kind of compact into one another. And if you only need 6 times, I mean, you have a couple, right? Let's say you go for hip surgery, you do max out of pocket, you have a hospitalization due to some kind of a freak accident, or you have food poisoning, or you have an accident, right? That's already 3 times. And most times, a lot of this stuff happens during the holidays. If you hit your max out of pocket in October, November, and then you go back again in January, you have a new or refreshed deductible to meet again. So a lot of times these can kind of push or hurt our pocketbook when it comes to paying more deductibles. Why pay a huge deductible when the Plan N is only, let's say $40 or $50 more per month? It doesn't make that much sense. So that's my spiel on the high deductible Plan F, what I think about inflation, what I think about kind of the economy, how it's working, and why now more than ever it's a good time to really look at your overall financial picture and see if there's any piece of it that's a little bit too risky for you. And if it is too risky, look again at, I did a video on Series I savings bonds. If that's, a little bit too, too unpredictable, you could also do something like fixed annuities. Fixed annuities pay nowadays up to like 4 or even like 4.5% per year. A fixed, so you could get like one for 5 or 6 years, 7 years, and it's going to pay guaranteed 4.5% interest, right? Or you can get a fixed income annuity if you need income. Now they're paying higher than they ever were before because the bonds are much more attractive as far as how much you can get. So there's other things, and just really think about it. You don't have to tell me about it. Financial planner, talk to them. You can inquire with me. More than happy to help. But that ends our almost half an hour retirement planning Friday. Lots again to talk about. I'll see you Monday where we talk Medicare. Till then, have a great weekend.